Hello and welcome to my channel. In this video, we would be covering chapter number 4, Investment Products. This video is part of NISM Investment Advisor playlist. So I recommend you to please go through the playlist. I have already uploaded many other videos. You can get the link to the playlist in the description box at the end of this video as well as on the I button. If you like the video, do hit the like button and please show some support by subscribing to the channel. It would be really appreciative and supportive for me. Now let's start with this one. Okay, so as I mentioned, chapter number 4 is totally focused on investment products. Now this is also one of the main chapter that you need to understand very well, because either you are going to invest as an individual or in future if you are going to make your career as an investment advisor. In both the aspects, you need to understand that what all investment options are available for you to make an investment. Now, you know that you want to get certain return percentage after a certain period of time. You have certain financial goals, but you have to know that what all are different options where you can invest your money, because only then you can analyze which option is most suitable and best for your investment, according to your capacity, according to your earning and risk-taking capacity, according to the return that you expect, the financial goal that you want to achieve. In all sort of analysis, you need to analyze different investment options and choose the best one, those options which can be best suitable according to your need. Okay, so that's why you need to focus on this chapter much, so that you can be a little, you can get a brief idea about what all are the investment options available for us. Now it has been categorized as per the module in four types. So the first one is small saving instruments, second is fixed income instruments, third is alternative investment options, and fourth one is direct equity investments. So I will be covering small saving instruments and fixed income instruments in this video. This chapter is very vast, so I have to make it in two parts. So this video is part 1, where we will be discussing about small saving and fixed income instruments. In part 2 of the same chapter, I will be explaining about alternative investment option and direct equity investment. Again, this chapter would be containing many questions, so I would be focusing and trying to make this easier for you to understand. Now, let me give you a brief idea about all these 4 investment products that has been categorized. So, starting with small saving instrument, what you need to know is that if we talk about the previous time when people were not much aware about making investment, so what government tried was to at least make people habitual of saving. Okay, investment was not a concept at that time. When we talk when we go through the previous times and we try to analyze things, we would know that people were much more interested in saving their money or keeping their money with themselves rather than using their money as an investment option to grow their money. They wanted to keep it safely. Now, from that time, government decided that at least they should provide an option to the people to make saving, and where they can trust upon, where they can trust and give their money to. So government introduced many saving schemes for people who wanted to invest very small amount over a period of time. Also, there was restrictions because people were not very comfortable investing a large amount of money at one go. So government decided that there should be options available where people can invest, where people can save their money, and that too with smaller amounts accumulated over a period of time. So this way, what would happen, that there would be a habit in people developed to make saving, and they would be able to accumulate a good amount of money which they can later use to achieve some of their financial goals, like getting a house, getting a car, or any such goal which they wanted to achieve, which require a good amount of money. Okay, so this was the main reason why small saving instruments was introduced, and why people became interested in these instruments was first because it was backed by government. So people usually didn't trust it at the time. People didn't trust, and even now people don't trust anyone for their money. They can't just give their money, hard-earned money, to anyone. So the major criteria was, when people are giving their money, they wanted it to be safe, in the safe hand. So small saving instruments were backed by government, it was introduced by government, and that's why people were having their trust on it. Generally, it also came with a maturity period. So people have to hold for a certain period of time. Even if they wanted, they can't withdraw the money because they won't be getting the benefit that was assured. So these instruments came with a maturity period. There was an assured interest. It means a certain interest rate like 6% or 5%. It was assured that after this period of time, after 5 years or after 10 years, whatever was the maturity period of that particular small savings scheme, after that maturity period, the individual would be getting certain amount of money. So people were having a clear idea that they would be investing this much and they would be getting more than that after a certain period of time, and that too with no risk. Also, it provided with tax saving options. So these all advantages made small saving schemes quite popular at the time in the people to invest their money, to save their money or accumulate their money over a period of time. Second, when we talk about fixed income instruments, so fixed income instruments is also referred as debt instruments. Okay. Now, debt instruments, it can be by government as well. It can also be by corporations or corporates. So it can be both by government as well as corporates. Now, debt instruments, if I give some of the examples, generally the most popular one is bonds, corporate bonds or government bonds. You must have heard. Now, bonds, how do they function? They provide periodic payments and the principal amount at maturity. So again, it is these debt instruments involve little risk, and it's again an investment option which people consider better than direct equity. For conservative people we are talking about. So conservative people who don't want to take much risk investing their money in shares, because there is so much of fluctuation in share prices, so they go for the fixed income instruments like bonds, the deposits, or the government securities. They usually go to that also. We would be discussing all those instruments in details in upcoming slides. Then in our next video, we would be talking about alternative investment options and direct equity investment. So alternative investment options, we would try to cover some of the investment products like derivatives, real estate, private equity, and venture capital. In direct equity, we would be talking about how people invest through IPO as well as trading in stock exchanges. So these all things we would be focusing majorly in this chapter number 4 in part 1 and part 2 videos. So the small saving instruments that we are covering in this video are Public Provident Fund, Senior Citizen Savings Scheme, National Savings Certificate, Post Office Scheme and Deposit, KISAN VIKAS PATRA, SUKANYA SAMRIDDHI Yojana, Gold Monetization Scheme, and Sovereign Gold Bond Scheme. Beginning with Public Provident Fund. Now, PPF is a long-term investment option. Now, this is the reason why it also becomes one of the lucrative option for retirement planning, because the tenure involved is a longer period of time. This makes individuals accumulate a large proportion of money. The interest that is earned on this particular investment, the interest as well as the return, is totally tax-free. And mostly the questions that you will be getting would be related to what is the minimum and maximum limit, then what is the tenure of this particular investment option, whether it is government or corporate. Mostly these kind of questions you would be getting, the kind of interest rate that is paid. So you need to focus. I have highlighted also, the PPF has a minimum tenure, which means the minimum time period for which the investment has to be made in Public Provident Fund is 15 years. Now, this can be extended in multiple of 5 years. So, after 15 years, it can also be 20 years, then 25 years. It can be extended in multiple of 5 years, but the minimum tenure is 15 years. Now, you need to notice, which is not mentioned here in the slide, is that partial withdrawal is also allowed after completion of 6th year. Okay, so for 6 years you have made this investment in PPF, you are allowed for partial withdrawals, which you can make out of your invested amount and can use for various purposes. Now you need to focus on this limit that has been provided. So minimum amount that needs to be deposited in this account is rupees 500 and maximum limit is 1,50,000. So as low as 500 and as high as 1,50,000 can be deposited in PPF account in one single year. Investments can be made in a lump sum or in maximum of 12 installments. Contribution to PPF is eligible for deduction under Section 80C. So as I already mentioned that small saving instruments are also getting popular because tax saving can be easily done and tax saving can be claimed under this section of 80C. So PPF also provides tax saving up to 1,50,000. And as you can see, interest and withdrawal on maturity is again completely tax free. The current interest rate that is going on, which is being provided under this PPF scheme, is 7.1% per annum. Senior Citizen Savings Scheme. From the name only, you can get an idea that this particular savings scheme, it is available for senior citizens. Now let's read the sentence. The Senior Citizen Savings Scheme is a saving product available to only senior citizens of age 60 years or above. So this is available for senior citizens age 60 years and above, but in some cases where there is voluntary retirement at the age of 55 years, those individuals are also allowed to invest in this particular savings scheme. Again, some KYC documents are required like identity proof, address proof and age proof, and it can be opened in any authorized bank or post office. Now let's come to this investment amount that is allowed. So the maximum amount that can be invested in SCSS account is up to rupees 15 lakh. The maturity period or the term for the scheme is 5 years. So you can see as compared to PPF, Public Provident Fund, where we saw the maturity period was 15 years. It is a shorter period of time because it is allowed for senior citizens. So the term period the term period is shorter as compared to the Provident Fund. A one-time extension of 3 years is allowed if applied within 1 year of its maturity. So one-time extension is allowed of 3 years, which makes it about 8 years if applied within 1 year of its maturity. Now again, Senior Citizen Savings Scheme is also eligible for income tax deduction, that is up to 1.5 lakhs under 80C, under Section 80C. And this tax deductions can be claimed to save on your taxes. Now one thing more is that premature withdrawals are also allowed. Here we see the maturity period was 5 years, but premature withdrawals are also allowed after 1 year of account opening. Again, you need to focus upon the current interest rate that is going on. So the current interest rate that is applicable to SCSS is 7.4% per annum. What we saw in Public Provident Fund, the current interest rate was 7.1% being provided per annum, and here it is 7.4% per annum. So it is slightly higher as compared to Provident Fund. Coming to National Savings Certificate. National Savings Certificates are issued by government and available for purchase at the post office. Now, NSCs are issued with a tenure of 5 years. Again, you can see what makes it beneficial, or some of the advantages which we can observe in National Savings Certificate is that the maturity period is small, which is only 5 years, and the certificates are available in really small denominations of 100, 500,000, 5,000 and 10,000, which fits into different capacity of individuals. So it can be started with really low amount. Again, it is eligible. Again, this scheme is also eligible for deductions under Section 80C of Income Tax Act. Now here it is written investments made in the NSC 8. Now, let me give you a brief about this. There was 2 types of certificate under National Savings Certificate. First was NSC 8 and second was NSC 9. Now, NSC 9 was discontinued by government in the year 2015 only. So now we are talking about NSC 8, which is eligible for deductions under 80C of Income Tax Act. The certificate earns a fixed interest which is currently at a rate of 6.8% per annum. You can make a comparison of interest rate as we are going with the upcoming slides. You can make a comparison. So PPF, it was 7.1%, the current interest rate. Then we talked about senior citizen savings scheme where the current interest rate was 7.4% per annum. Here it is lower as compared to both of them. It's 6.8% per annum. But you can also see the advantages, how it can be started with lower amount of money, and again the shorter maturity period of 5 years. Post office scheme and deposits. So Indian Post offers various savings scheme with guaranteed return that is backed by government. 3 of which we have mentioned over here: post office monthly income scheme, post office dime deposits, and post office recurring deposit. Now again you have to see the investment amount, the limit, as well as the interest rate. So I guess the interest rate is not mentioned. Anyways, I will be mentioning. The post office monthly income scheme provides a regular monthly income as the name suggests. This scheme has a maturity period or term period of 5 years. Now minimum amount that can be invested is 1500 and maximum is 4.5 lakh for a single owner. If it is held jointly, if the account is held jointly, the maximum amount is 9 lakh rupees. Now currently the interest rate that is being offered under post office monthly income scheme is about 6.6%. Coming to post office time deposit, it's most like the fixed deposit that we have in bank. So post office also offers with this time deposit similar to fixed deposit of commercial banks. It accepts deposits with term of 1 year, 2 year, 3 year and 5 years. The minimum deposit amount is 200. You always have to keep these amounts in mind because mostly the questions would be about like what is the minimum tenure, what is the maturity period, what is the minimum and maximum limit, etc. So the minimum deposit amount is rupees 200 and there is no maximum limit to it. Now this post office time deposit, again this is eligible for tax benefits under section 80C and only the post office time deposit. When we talk about this post office recurring deposit, it is not eligible for taxation. So post office time deposit is eligible under 80C for tax deductions. Now the current interest rate that is being offered under this time deposit is 5.5%. For POMS it was 6.6% and for POTD it is 5.5%. Coming to post office recurring deposit, most like in commercial banks that you are having your recurring account, the maturity amount with interest is paid at the end of the term. Interest is taxable and deposits have to be made regularly on a monthly basis. That's why it is called recurring deposit, because you are repeating your investments that is being made. Recurring means repetitive or continuous, consistently that you are making your deposits on monthly basis. The current interest rate that is being offered under this post office recurring deposit is 5.8%. For POMS it was 6.6%, for POTD it is 5.5% and for PORD it is 5.8%. KISAN VIKAS PATRA. Initially it was meant for farmers to enable them to save for long term and hence the name. Now it is available for all individuals. So from the name only you can get an idea that this particular saving scheme, it was introduced or it was started targeting the farmers so that the farmers get an option to invest a very lower amount and they can save certain amount which they can use for their farming purposes or various other purposes which make their life more stable. But now it has been available for all the individuals. And again let's come to its tenure. So let's see, as per the latest update, the tenure for the scheme is now 124 months, that is 10 years and 4 months. Now this scheme has lock-in period of 30 months, which means before which investors cannot withdraw their money. This line will make it clear KVP can be prematurely encashed 2.5 years from the date of issue. Okay, so only after 2.5 years or only after 30 months, investors can withdraw their money. Before that, they can't do that. Before that, they can't withdraw their money. Now, one thing more I would say that you need to focus is that there is no tax incentive for the investment made under KISAN VIKAS PATRA. Interest earned that is also on that also tax is applicable. So some of the saving schemes where we saw that it was eligible for tax deductions, you need to make a difference. Okay, write down what all schemes were eligible for tax deductions and what all schemes that is mentioned is not eligible for tax deductions, so that you can, if you get such a question that which scheme out of all the options is not eligible for tax deduction, you can choose the correct one. The current interest rate that is going on is 6.9%. Okay. Moving to Sukanya Samriddhi scheme. The Sukanya Samriddhi account is a scheme launched for the benefit of girl child. The account has to be opened in the name of girl child by a natural or legal guardian. So this again is a government initiative that was launched in the year 2015. It was intended to promote girl child's education and marriage and financial well-being. It was also in support of this campaign called Beti Bachao Beti Padhao. And let's look at some of the key points of this scheme. So only one account can be opened in the name of a child, and a guardian can open a maximum of 2 accounts in the name of 2 different girl children. So only one account is allowed per girl child. Now if in a family there are 2 girl children, so on the name of both the girl children there can be maximum 2 different accounts. The age of the child cannot be more than 10 years at the time of opening the account. Again, this is a criteria that need to be fulfilled. If your girl child is more than 10 years of age and then you have went to open this account, it won't be allowed. So the girl child should be less than 10 years or 10 years at that particular point of account opening. The minimum investment in the account is rupees 250 in a financial year and maximum is 1,50,000. Prior, this amount was rupees 1,000, but again to promote this scheme and to make it more popular, the amount has been reduced. Now the minimum investment amount in this account is 250 in one financial year and maximum is 1,50,000. Sorry. There is also this fine is also imposed, which amounts to, I guess, rupees 50. So if someone is not able to pay the minimum amount or whatever the deposit amount at which the account was opened and that was intended to be deposited under this scheme, if that is not meant, the fine of rupees 50 is imposed on the guardian or the parent. The minimum investment, okay, we covered this. The account will mature on the completion of 21 years from the date of opening the account. So this scheme will mature after 21 years from when the account has been opened. Now it also allows the girl child to operate her own account after she reaches the age of 10. And the account also allows 50% withdrawal of the money at the age of 18 for higher education purpose of the girl. So when the girl child becomes 18 years of age, 50% withdrawal of the amount that has been deposited is allowed. And again, that I mentioned, that girl, if she reaches the age of 10, after that she can operate her own account. The interest rate, the current interest rate that is going on is 7.6%, and again it is under section 80C of Income Tax Act. So tax deduction is provided. It is fully exempt from tax. Gold Monetization Scheme 2015. The gold monetization scheme is a scheme that allows eligible resident investors to monetize the gold held by them into interest earning deposit with all scheduled commercial banks, excluding RRBs. So this scheme was launched by Government of India in 2015, and under this scheme the individuals were provided with an option to deposit their gold, and they can earn interest over it. Now what exactly happened was that individuals, they were keeping their gold in their households. Now that wasn't earning any interest, and there was also this fear of security for the gold that is kept idle in the houses. So bank provided with the option of earning interest on whatever gold you were having in your household. You just deposit it with the bank. The bank will be providing interest that will be credited periodically to the account, and along with that you will get a secure storage system. So many people, they hire bank lockers and then they keep their gold, for which they pay charges. So here your gold is kept as deposit and you are being paid the interest, and it was also in benefit for the country because their dependency on import of gold was reduced. Now let's see, the minimum gold that can be deposited under the scheme is 30 grams and there is no maximum limit. Okay, the gold can be converted into short-term bank deposit, that is between 1 to 3 years, or it can be medium term 5 to 7 years, or long term 12 to 15 years. The interest will be credited periodically to the account and can be either withdrawn or allowed to accumulate till maturity. So you can choose the option whether you want to convert the gold that you have deposited into short term, medium term, or long term bank deposit. Let's come to this sovereign gold bond. The sovereign gold bonds are government securities denominated in grams of gold. The bonds will be denominated in multiples of gram of gold with a basic unit of 1 gram. So you need to see the tenure of the bond, that is 8 years with exit option after 5th year. So after 5 years of investment, you can make an exit from this particular investment, but actually the maturity period or the term period for this particular bond is 8 years. The value of bond will reflect the price of gold. On maturity, the value of bond may be higher or lower depending upon the prevailing price of gold. So we know that gold prices also fluctuates in the market. So on maturity, the value may be higher or lower. So there is a risk involved as in the fluctuations in the prices of gold. The bond bears an interest rate of 2.50% per annum on the initial investment and is paid semi-annually to the account of the bondholder. At maturity, whatever would be the prevailing price of the gold, you would be getting that, and the interest rate of 2.50% that is applicable per annum, which would be paid semi-annually. Early redemption is allowed after 5th year from the date of issue, as mentioned over here. The minimum investment is 1 gram and the maximum is 4 kg for individuals and Hindu undivided families, that is HUFs, and 20 kgs for trust and other similar entities per fiscal year. Now let's move on to our fixed income instruments. Government securities are issued by RBI on behalf of the government. G-Secs represent the borrowing of the government mostly to meet the deficit. Okay, so government securities are debt instruments which guarantees full principal payment at maturity along with periodic coupons. Now this type of instrument again is considered risk-free because it is backed by government, and obviously government by issuing these securities is trying to raise the fund which can be used to meet the deficit. Deficit here means if the expenses of government is more than the income of the government. So there is a gap, there is a deficit in the fund. So that to fulfill that gap, to fulfill that deficit, government issues securities which to raise fund from the public, from the institutions, whoever is participating, the trust, the institution, the corporates, as well as the public. So government securities, as I mentioned, you need to remember, is debt instrument, again backed by government, which makes it risk-free, and as any other bond works, the full principal payment is given at the maturity along with periodic coupons or maybe interest payments periodically. G-SECs are benchmark securities in the bond market and tend to offer a lower interest rate compared to other borrowers for the same tenure. One thing also you need to consider is that because these government securities are considered risk-free as it is backed by the government, the interest rate that the individual investors would be getting by investing in G-SECs would be lower as compared to the corporate bonds. Okay, since the risk involved is lower, there is lower return that you are getting. Investors, either they hold it till maturity or they sell to other investors on secondary bond market. Interest is paid out on pre-specified dates into the designated bank account of the investor. Interest is not subjected to TDS but is fully taxable. In order to buy G-SECs, retail investors have to open a Constituent Securities General Ledger, that is CSGL account with their bank, and the minimum investment amount is rupees 10,000. Let's look at these corporate bonds. Corporate bonds are debt instruments issued by private and public sector companies. As we saw that government securities were the debt instruments or the bonds that was issued by the government, corporate bonds are issued by private and public sector companies. They are issued for tenors ranging from 2 years to 15 years. Now these corporate bonds are also provided with rating which shows how safe a particular bond is or how reliable a particular investment in that bond, in that company's bond is. So rating is also provided by various rating agencies which need to be considered before investing in the corporate bonds. They have to be compulsorily credit rated and issued in demat form. The coupon interest depends on the tenor and credit rating of the bond. So again, as I mentioned, that how a particular bond functions is that the principal amount you get on the maturity, and then there is periodic coupons or interest payments that is being provided to the investors. And some of these bonds, they are issued at a discount to the face value. The price of the bonds in the market will respond to changes in interest rates. Secondary market trading in corporate bonds is usually concentrated among institutional investors. So anyone who is not clear about bonds and not getting what I'm trying to explain over here, you can pin me in comment. I will be providing a separate video link to you about these bonds or debt instruments, which will make your understanding more clear once you watch that video. Okay. Most transacted types of bond are zero coupon bond, plain vanilla bond, and convertible bond. Does not need to go in so deep to understand all these bond forms because your module does not concentrate much upon fixed income instruments. I covered the small saving instruments in details because that would be in focus for your exam. Let's come to the bank deposits. You need to know that these are the fixed income instruments and a little brief about all these. Bank fixed deposit is also called as term or time deposit, as it is a deposit account with a bank for a fixed period of time. Interest rate depends on the duration of deposit, amount deposited, and policies of the bank. In general, longer will be your term deposit, you will be getting higher rate. Shorter will be your term deposit, you will be getting lower interest rate. Now, banks may also prescribe a minimum lock-in period during which funds cannot be withdrawn from your FD account or fixed deposit account. They may levy penalty also if the depositors are making premature withdrawals. Now, investment in specified under Section 80C of the Income Tax Act, 5-year bank FDs are eligible for tax deductions up to maximum amount of 1 lakh rupees. So again, you need to consider this point that your bank fixed deposits with your bank are eligible for tax deductions under Income Tax Act of 80C, that is up to amount 1 lakh rupees, and for 5-year bank fixed deposit. Thank you for watching.